Welcome to Section 3 of the ASC 323 series, where we tackle two critical adjustments that shape what you report as equity and earnings. By the end of this section, you will be able to spot a basis difference, allocate it correctly, amortize it, handle the goodwill remainder, and eliminate unrealized profits from intercompany trades. These are the skills that separate a clean equity pickup from one that overstates your earnings. Think about the last time your company paid a premium to acquire a stake in another business. That premium did not appear out of thin air. It reflects real value embedded in the investee's assets that the book value simply does not capture. When you pay more than your share of net book value, you have a basis difference. The accounting rules require you to track exactly where that extra cost lives, because different assets have different useful lives and different implications for your reported earnings. You cannot lump it all together. Each piece needs its own home. Next, we will look at how to break that difference apart systematically. The allocation process mirrors what you do in a business combination, just scaled to your ownership percentage. Start with identifiable assets, property and equipment, intangibles, favorable contracts, anything with a fair value that differs from book. Multiply each gap by your ownership stake to arrive at your share of the undervaluation. Assign those amounts. Only after you have exhausted every identifiable asset and liability does the remainder qualify as goodwill. Getting this sequence right matters enormously because identifiable asset allocations get amortized over time, while the goodwill piece does not. That distinction hits your reported earnings every single year. Here is how the numbers work in practice. You paid $600,000 for a 30% stake. Your share of the investee's net book value is only $450,000. That leaves a $150,000 basis difference to allocate. The investee's property and equipment is undervalued by $200,000 on its books. Your 30% share of that gap is $60,000, which you spread over the remaining 10-year useful life. The intangibles are undervalued by $100,000. Your $30,000 share is amortized over 5 years. That accounts for $90,000 of the $150,000 excess, leaving $60,000 as embedded goodwill. Now let us look at how those amortizable amounts flow through your journal entries. Each period you reduce your equity and earnings by the amortization on identifiable basis differences. $6,000 for the PP&E piece, $6,000 for the intangible piece, $12,000 combined each year. The entry is a debit to equity and earnings and a credit to the investment account, reducing your carrying value. The goodwill component works differently. You do not amortize it separately, and you do not run a standalone impairment test on it. If there is an impairment concern, you assess the entire investment as one unit. Keeping these two treatments distinct is one of the most frequently tested areas in equity method accounting. Now we shift from basis differences to the second major adjustment, intercompany transactions. Here is the core problem. Your investee sells goods to your company, books a profit, and you pick up your share of that profit through the equity method. But the inventory is still sitting in your warehouse. No third party has paid for it yet. The profit is not economically real until an outside customer completes the purchase. If you leave that unrealized profit in your equity pickup, you are overstating your earnings without any market validation. The elimination rule forces you to defer that profit until the economic cycle is actually complete. The critical word is unrealized. Only what remains unsold needs to come out. Let us look at how this plays out depending on which direction the sale flows. An upstream sale flows from the investee up to the investor. The investee makes the sale, records its profit, and you pick up your share through the equity method. If that inventory is still on your shelves at period end, the profit has not been validated by the market. You reduce your equity and earnings by your ownership percentage of the unrealized amount. At a 30% stake, a $50,000 profit on goods still in your warehouse means you eliminate $15,000. The direction of the sale, investee to investor, is what makes it upstream. Downstream is the mirror image, where you are the seller. A downstream sale flows from the investor down to the investee. You sell inventory to your investee. You book that profit on your own income statement, and separately you are picking up earnings through the equity method. If that inventory is still sitting in the investee's warehouse at period end, the economic cycle is not complete. You reduce your equity in earnings by your ownership percentage of the unrealized profit remaining in the investee's unsold stock. Because you are on both sides of this trade, the standard gives you no relief. Your full proportionate share is eliminated. That profit only becomes real when a third-party customer steps in and pays for the goods. The elimination is not a permanent write-off. It is a timing difference. Once the investee or investor sells the intercompany inventory to an outside customer, the profit is realized. You reverse the prior elimination and recognize that income through equity and earnings in the period of the third-party sale. This is why period-end reviews matter. What was unrealized last quarter may be fully realized this quarter. The discipline is straightforward. At each reporting date, determine how much intercompany inventory remains unsold and what profit margin it carries. Getting that number right keeps your equity and earnings accurate without overstating or understating what you have genuinely earned from the market. 2 adjustments, 1 purpose. Making sure your equity and earnings reflects economic reality. Basis differences correct for the premium you paid by spreading that cost over the lives of the underlying assets. Intercompany eliminations correct for profits that look real on paper but have not yet been validated by the market. Together, they keep your reported earnings honest. Apply the allocation sequence carefully, track your intercompany inventory balances at each period end, and remember that goodwill sits at the investment level, not as a separate line item subject to its own testing. Thank you for completing this section on basis differences and intercompany transactions. In the next section, we move into some of the most challenging equity method scenarios. What do you do when your investee keeps posting losses and your investment account approaches zero? How you assess and record an impairment, and how changes in ownership percentage alter the accounting model you apply. These are the situations where the equity method gets tested most rigorously, and knowing the rules will keep you on solid ground. Thank you for watching. Subscribe for more training from PNJ Group.